There's a very high chance the Fed cuts rates in June, and when that happens, millions of investors are going to do the same thing. Move out of bonds and rotate their portfolios. Now, this move that everyone makes when rates drop isn't wrong. It's just not the move that actually matters, not right now. Because there's a 200-year-old mechanism that most people have never heard of that draws a very hard line between who builds wealth when rates drop and who falls further behind. Now, once you see this line, the conventional advice doesn't just look wrong, it looks like a trap. So in this video, I'm going to expose exactly what the mechanism is, why it matters right now, and how you can benefit from it. You ready? Let's go. All right, so we're gonna jump right in. We're gonna talk about the potential for rates to come down. Now, at this point, it's sort of like a foregone conclusion. Most of the people are already on that side of the trade, but what I'm gonna tell you today is that I think most of those people are misunderstanding what's going on and are taking the wrong move. But don't worry, we'll tell you what that right move is. Okay, but let's just take a look at this real quickly. So, of course, President Trump has been very outspoken. He wants rates down. He wants rates down really bad. He's been fighting against the Fed. He's been calling Jerome Powell all kinds of names from his first term, his second term, calling him things like too late. He wants rates down. Of course, Jerome Powell's on his way out. I'm catching you up. Of course, you already know this. We have a new Fed nominee, Kevin Warsh, and he is going to take over the Fed, and he is maybe going to do Trump's bidding. We're going to take a look at that. So what we can see here is that Kevin Warsh is nominated to come over and take over from Jerome Powell. Now, he's previously made statements aligning with Trump on interest rates, criticizing the Fed's hesitancy to cut rates. So he's already been critical of the Fed because they haven't cut rates as well. So we can see that he said their hesitancy to cut rates, I think, is actually quite a mark against them. So again, he thinks they should have cut rates. He's been critical like Trump has. Trump wants them cut down. And so, of course, Warsh is probably going to have to comply with that. We can see here it says that Trump has repeatedly said he wants the next Fed chair, Warsh, to deliver lower rates, and on January 30th, 2 days after his policy meeting, he announced he would nominate Warsh, a former Fed governor, to take his place. Trump wants him down. He's nominated Warsh. He nominated Warsh to bring them down. Warsh has been critical of the Fed because they wouldn't bring them down. And so we can see that they're coming down. And we can also see that there's a lot of cover. Now, while CPI is still in the 2.5 range, which is saying, well, that's higher than what the Fed wants, we can look at another measure like trueflation and see that inflation is actually much lower. Tariffs have been deflationary. AI is coming on very quickly. That's deflationary. And the reason why I bring this up is this is all the cover the Fed needs in order to cut rates. And so a lot of people are looking at the wrong metrics and they're being caught off guard. Now, if we look at the data, this is the CME watch tool, and this shows us that after Warsh is elected, this shows a very high probability, above average chance that rates will be coming down. And that's on the CME watch tool. We can see the betting markets here on Poly. We can see that there's a 51% chance. As of right now, that's going to go up much higher. I believe that Trump gets his way. He's used to doing that. He says he wants rates by 1%. I think they're there before he leaves office. So that being said, what does this mean? What does this mean to us as investors, as asset holders? What do we do with this information? Well, I want you to understand the mechanical movements behind this so you can understand this from a first principles level, and then we'll talk about how we build wealth. So the first thing we have to understand is what happens when rates come down? Well, it makes borrowing cheaper. Let's explain this for a second. Now, a lot of people maybe don't understand this, but it's interesting to me when I look at Black Friday. In the United States, Black Friday, between Thanksgiving and Cyber Monday is one of the biggest shopping days of the year. Things go on sale, and you'll see it all over the country. People go to like Best Buy or Walmart, and they'll stand in line all night just to be able to buy the TV or whatever it is cheaper. I always find it interesting that when financial assets go on sale, people are afraid. It's interesting. But let's just take a look at this for a second. What I want to show you is that when things get cheaper, people tend to buy more of them. Let's take a look at this. So what we can see here, daily online spending, typical days versus holidays, Black Friday and Cyber Monday. So what we can see is that Cyber Monday spending is 6 times typical of a regular day, a non-holiday day. So here's an average non-holiday day. Here's an average holiday, non-holiday, holiday. But on Black Friday and Cyber Monday, look how much higher they are. Why? They're that much higher because the rate of discount. So check this out. The average Black Friday discount percentages, so from 2015 to 2025, we can see it's about a 40% discount. So when prices drop about 40%, people come out in droves to buy, as you can see that. But check this out. So here I have an iPhone in my hand. I don't know how much the new iPhone costs, $1,400 or something like that, which means it takes me $1,400 to buy an iPhone. Now, if Apple said, hey, we're going to put the iPhone on sale and we're going to sell them for $500 for only 48 hours, do you think they would sell more of them? Of course. Of course, they would sell more of them. They're set for sale for $500, as the data shows us. Now, I can use $1,400 to buy an iPhone, but what you maybe have never thought of is I can buy $1,400. I can buy $140,000, or I could buy $1.4 million. How much does it cost to buy $140,000? How much does it cost to buy money? It's the rate of interest, right? So when the interest rate goes down, that means money gets cheaper. If money gets cheaper, that means more people buy it. Are you following me? So then what happens? Let's check this out. So there's a little known mechanism. As I said, it's about 200 years old. It's called the Cantillon effect. I'm sure some of you guys have been watching my channel for a long time. Have heard me talk about this in the past. So the Cantillon effect basically tells us that whoever's closest to the money supply, whoever gets the money first, has the biggest advantage. So new money doesn't reach everybody at the same time. New money goes out to some people first, and then it trickles through the economy. The early recipients, they buy assets before prices rise. Everyone else gets it later when prices go up. Let's look at this official definition here. The Cantillon effect describes how new money injected into an economy causes uneven price increases, because not everybody gets it at the same time, benefiting those closest to the source first, e.g., check this out, this is deep, e.g. banks, governments, and corporations. Before it then does what? So first the money goes to the banks and the people, then it inflates prices for the general public. This is named after an 18th century economist, blah, blah, blah. Early receivers get to spend money before prices rise. So they get the money and get to spend it while prices are still cheap. And by the time everybody else gets the money, prices are expensive. So the first people that get it, their money buys more, but when everyone else gets the money, their money buys less, okay? So check that out. But here's the thing. Which one are you? Which side are you? Well, let's break this down. So you ever heard the saying, if you can't beat them, join them? How about that? So what we have is whoever gets the money first, and my partner at the Bitcoin Opportunity Fund, James Lavish, put this chart out, the informationist, so I'm stealing it from him. But he talks about how the Fed creates the money, and it goes here to level one, which is banks, financial institutions. They get the first access to the money, and they buy assets. So they get the money, they buy assets. Then it goes to large corporations, and they invest and start to expand. Then it trickles down to here, and now the asset prices, homes, shopping, utility bills all go up. Asset prices go up first, stocks go up, real estate goes up, asset prices go first. Then level 4, consumer prices go up. So then gas goes up, food goes up, things like that, everyday costs go up. And then the people down here, the bottom, then wages, how much you make is the last thing to go up. So by the time the little bit of money gets to here, everything else has gone up first. Okay, now while that sounds bad, and it is, this is the flywheel that works. So what I would like to tell you is, instead of looking at things happening to us, maybe we could think about things happening for us. And so if we have rates coming down, money gets cheaper, debt gets cheaper, but assets go higher, and inflation destroys the debt. So if I have a 30-year home, a 30-year real estate property, and my payment is, say, $3,000 a month. Today, $3,000 a month is a lot of money. In 10 years from now, $3,000 a month is not that much. In 20 years from now, $3,000 a month will probably be very little. And so what happens is the money gets cheap, assets go higher, inflation destroys debt. So the question I would ask you, yourself is, why are you here? If the people that get the money first are the banks and they buy assets and they have the benefit, then why don't we partner with the banks to get the money first and buy the assets? The reason why is nobody's ever thought about it like that. You've been stuck playing the wrong game. So what I'm saying is I can just go to the bank. And what do the banks do? The banks create money. How do they create money? By issuing debt. So every time they create debt, money's created. But who do they issue debt to? People like you and I. As a matter of fact, every one of you watching this has debt. The problem is most of you use debt for the wrong uses. You use debt on your credit card to buy the vacation. You use debt to go buy a car that's going to lose value. You use debt to buy a new wardrobe. You use debt to do whatever. And so for you, debt is very dangerous. And for you, you're like, oh my gosh, that sounds dangerous. What if I can't pay the debt? But what the wealthy do at the top with the Cantillon effect is they use the cheap money when it goes on sale to buy assets that go up in value. But what if they can't make the payment? What do you mean not make the payment? They have the asset. They didn't spend it on frivolous vacations and wardrobes. They bought the asset. So they have the money. Now, I know for most people, this seems completely foreign. But the fact is, whoever's closest to the money gets the first benefit. And who's closer to the money? The person that is there upon origination, when the debt gets issued. Now, I know that sounds dangerous. So let's talk about this for a second. As I said, number one, when I use debt for the asset, then I have the money. But what if the tenants don't pay the payment? What if the market crashes and the valuation of the home goes down? What if all these bad things that could potentially happen? So what you're saying is there's potential risks. So what we can do is we can name each one of those, and then we can learn to mitigate on each one of those. How do we do that? We do that using what I call the 4 layers of liquidity. Now, cash, most people think money or cash or savings in the bank is liquidity. Now, money, cash, savings is liquidity, but liquidity is not cash. They're not the same thing. You hear me talk a lot about the macroeconomics environment. We talk about the global liquidity. And as the global liquidity goes up, then we see asset prices rising, right? Bitcoin is very sensitive to global liquidity. Now, global liquidity is not just global M2. It's not just the money in the world. It's the money, but it's also the credit and the ability to create more money, because money is created through debt issuance. So liquidity, cash is liquidity, liquidity is not cash. So it's the ability to get it. So for example, let me break this down. In layer 1, I want to make sure I have enough money to operate. So this is all my expenses. This is all my debt, my house payment, my mortgage payment, my car payment, my electricity bills, my food, all of that. I have rental properties, all those payments, I have credit, everything. How much does it cost me to operate? And then how many months should I have as a buffer? 3 months, 6 months, 9 months? However much you think makes it safe for you to operate. Then below that, what happens below that? Well, then I can have layer 2. Layer 2 is what I call my second layer of liquidity, or this is emergency money. This is not cash. This is not savings, because money in the account is like a melting ice cube. It's losing. So I want that in high yield. I want that earning yield. I want it earning 5%, 10%, 12%. But I need it in like a cash-like equivalent, meaning I could get the money in, say, 7 days. It's not money in my bank, but I could get the money within 7 days, and there's not much volatility, so it's always there when I need it. That'd be layer 2. Now, how much? So if we have, let's say, 1 to 3 months here I could have, say, 3 to 6 months, maybe to 12 months here. Then layer 3, this is where my assets are, but the assets are collateral. So for example, I have houses, I have apartment complexes, I have Bitcoin, I have things like that. Now in there, those assets are also collateral assets, meaning on the homes that are here, I could have home equity lines. I have businesses, I could have business credit lines. I have credit cards, I could borrow against my Bitcoin. I have assets that if I needed to get more money, I could pull against those assets. I don't do it if I don't need to, but that's my third line of defense. And so if some catastrophic thing happened where I couldn't make the payments, I have money here. And if for some reason it was so bad that this ran out and I couldn't afford it, well, then I default to this path. And if for some reason it's so bad that I couldn't even imagine that not only did I go through this, I went through this, now I have all of this. Then down here is my non-liquid stuff. So this is my private equity investments. This is my venture capital investments. This is land overseas. And so all of this is built to protect this. So what I'm saying is there's a way to engineer this. This is what banks do. Banks take in assets, they issue credit on top of those assets, and they make sure they have the liquidity to withstand the volatility. That's how the game is played. So really, when we look at this thing called the Cantillon effect, which again has been around for hundreds of years, we've known at this, most of us just take this victim approach. And we think, woe is me. The wealthy people, they have access to the money first, and so they get the proportional benefit, and I get at the very bottom, and my wages go up in price, they're expensive. But what we could do is say, well, shoot, they get access to the money first because they create the money, but they create it through debt issuance. And who do they issue the debt for? Oh, that's me. And, oh, yes, I use debt, but I'm using debt completely the wrong way. And I could use debt to grow my wealth, but it's dangerous. So I should think about the things that are dangerous, and then I could mitigate those risks, and I could engineer that. I could engineer that system. So the question is, which side of that do you find yourself in? Do we use these tools or do we not use these tools? This is how the 1% build wealth. Let's take a look. Donald Trump, before he was president, he was famous because he was a billionaire. He famously said, "I'm the king of debt. I'm great with debt. Nobody knows debt better than me. I've made a fortune by using debt. And if things don't work out, I renegotiate the debt." He's repeatedly described leverage as essential to building his real estate empire. Donald Trump, the king of debt. Now, look, a lot of you think that building real estate is the key to building wealth, right? Nobody thinks that you would buy real estate with cash. Of course you use debt. Robert Kiyosaki, my mentor, constantly contrasts good debt versus bad debt, arguing that good debt, borrowed money used to buy producing assets, is what makes the rich richer. That's what the rich do. The Cantillon effect. They get the money first, they buy the assets. He openly says the rich often have large amounts of debt and calls the idea of being totally debt-free financial insanity when you can use cheap debt to buy cash flowing assets. Again, think about this. Think about the mechanism. The government, Warsh and Trump, they lower rates. They make money cheaper. When money gets cheaper, more people buy it. It pushes asset prices higher, and the inflation that happens destroys the debt. So they give me the money cheap, my assets go up, and the debt gets destroyed. That's the plan. That's what they do. Now, again, most people are going to do nothing with this, and that's their choice. But some people will build this. I just urge you to build it with proper structure, recognize the debt is dangerous, mitigate against that risk. But that's what I got for today. Hopefully this makes sense. As I always say, to your success, I'm out.